have more locations in more countries than WeWork. You have 5 times the members. You have almost double the revenue. You've got a profit instead of a loss, and your EBITDA margins are positive versus negative in the case of WeWork. Your market cap is $4.5 billion. So when you heard people talking about $47 billion for WeWork, what did you think?
Well, I thought it'd be great if they could achieve $47 billion because, you know, we do exactly the same business, as you say, in many more countries, many more locations. So maybe our price would go up. But, you know, it was hard to understand how that sort of valuation could be achieved. It is the same business in every sense.
Were you scratching your head for a long time over this?
Yeah, I've been scratching my head for a while on it. But look, these guys have been great for the industry. They've done a lot of good things. And overall, it's been beneficial to our company. We've grown strongly in all of the past 3 years as a result of more and more interest in companies outsourcing, in companies getting property off the balance sheet, and digital just changing how people work and where people work. So
validating the business model to a certain extent.
Absolutely.
One of the things that they've been so criticized for is growing so rapidly. That's something for a long time. People thought, great, you've got to get big, you've got to build the moat. What does this make you think about that?
It's dangerous. You know, I've been doing this for 30 years, started off with 1 center in Brussels in Belgium. We've got 3,500 today. It's a tough one. If you grow quickly, you can take a lot of risk doing that. So, you know, this is a business where, you know, I tell people coming into it, there are no shortcuts. And it's a very operational intense business. So you've got to execute well, all the time, every day.
Long term, do you think, though, that their tactic, as it were, to expand very quickly and get scale was the right one? I mean, is scale important in this marketplace?
Scale's critical. You see, what the customer wants is the modern customer, the modern corporation. They want to use space across a country. They don't, you know, the days of headquarters buildings and people commuting will be becoming less and less, and will be a rarity in 5 years' time. So that's what's causing the change. But you need to be where people live, not just where people work. And you need to be in every part of the country.
I want to go back to the valuation point, sorry, Mike, that Becky was saying, because I think you trade at about 1.5 times your revenues, and you've done a little spin-off recently that was valued at 3 times, so better than that. WeWork's valuation multiple compared to that was far, far higher. Clearly, that didn't work. What kind of valuation multiple do you reckon they can get compared to their revenue now that they're in a more limited marketplace for funding?
It's hard for me to comment, but look, what I can say is that, I mean, next time round, it's going to be difficult. And what you have to have in our industry is great disclosure. You know, we're a public company, a huge amount of disclosure. That's what investors want. You've got to bring investors up to speed with what we do and how we make a profit. You're not going to do that with limited disclosure.
You mentioned kind of the same business in most respects. So a couple of the criticisms of WeWork's business was, one, entering into long-term leases and then offering shorter-term leases, right, to tenants. And then also those tenants being largely startups. And so there was an added risk of these businesses have not been around very long. You mentioned corporations. Is your business more skewed toward larger companies? And you also just release your properties?
Yeah, we, you know, having been through many cycles, every year we do cycles. You know, we're just in the middle of Venezuela, places like this. You know, the world is not a flat place. So the most important thing is managing your risk. So it's making sure that you don't have too much liability and you've got a good forward order book, and you need flex. About 40% of everything we do in joint venture. So you're managing the risk. You're getting variability, most of all into your rents.
You've been through lots of cycles. I mean, I think you first listed back in '99. Mm-hmm. Your US business filed for Chapter 11 at one point. It's now doing much better again, and we started. Talk us through that cycle and whether WeWork might not be ready for that kind of downturn in macroeconomic.
You know, downturns come. I mean, look, this is a pretty good market at the moment. You have to be ready for it. You have to be ready for it all the time, because you just don't know when it's going to arrive. So getting that flexibility in. We learned our lesson in 2001 actually, the year after we IPO'd. The key is, making sure you've got flexibility, low debt, and we carry almost no debt today. And making sure the best thing of all is to make sure you've got strong positive cash flow going into it. But it's a good opportunity to grow. I mean, this is an industry which will grow and will grow even more strongly during the next recession when it arrives, or the next downturn, because the demand for it from corporations is very real and grows all the time, especially with the new change in the accounting rules.
Mark, not to harp on these same points, but when we had Sam Zell, who's a legendary commercial real estate investor, on set with us, and he was looking at WeWork, he said, look, I've looked at business models like this going back to the 1950s. It never works out because in a recession, they're the first ones to lose their tenants. How long is your average lockup time with tenants at this point? How long do you lease, and how long do you then turn around and lease?
Well, again, we sort of, all of that for us is public information. Especially with IFRS 16, which is quite rigorous in disclosure. So we have about $5 billion of liabilities, but we also have a forward order book that's pretty well matched to that. And also many of the arrangements are variable, and we have much shorter time spans on the leases. So we tend to pay a little more to have optionality on leases rather than fix for 15. We would never do 15 or 20 years. Hard to price that for the long term.
What's your view on some of the investment bankers and indeed the CEOs of JP Morgan and Goldman Sachs who kind of rubber stamped the terms of the S1 and the valuation that they initially were going for?
Again on that, I can't really comment on that. Look, it was there, and they must have believed that the valuation was there. In the end, we wait and see whether they can restructure, and I'm sure they will do a great job of that, but it's a tough one going forward.
What do you see in the European economies right now? Because we hear all this concern about what's happening with the economy and whether that will wash up on the U.S. shores. What do you see in your portfolio?
Well, if we look at our businesses in Europe, they're actually doing well. Our Spaces brand continues to grow. It's very popular in Europe. Regis as well, our main brand, continues to grow. We're seeing unusually very strong activity in Southern Europe and places like France, which have been flat for a long time. They're doing very well. UK, we're very, very cautious on for obvious reasons. I mean, it's more companies are moving to flexible because they don't know what's going to happen, but there's a lot of uncertainty. Really, for us, the star of our business is the United States and Canada, which have seen fantastic growth. And you've got more corporations in America switching over to flex space than anywhere else. They're really sort of at the vanguard of changing the way that they support their people. And there's a lot more people now starting to work from close to where they live and not being forced to commute into the cities. And that sort of trend is something that's going to pick up, we think, more and more in the coming years.
Where would WeWork's valuation have to come to for you to consider looking at it?
That's a very good question. Look, consolidation's always a great thing, and I think in the coming years, I think there will be more consolidation. That will be a result of what's happened with WeWork in the last couple of weeks. But again, it's the same business. What can I say? Your comments are the same business, doing the same thing. We have a great digital platform. It's our app that's at the top of Google App Store and the Apple App Store. It's completely, we have all those things. So same business, look at the revenues, look at the margin. I mean, you'd have to think that whatever our value, they would have the equivalent.
Mark, I want to thank you for joining us. It's good seeing you.
Pleasure.